this week's market update, shares enjoy their best first quarter in many years. That's despite a warning sign from the bond market. Lift fails to ignite the new issues market. Donald Trump talks the oil price down, and Brexit stumbles on. The headline writers were left scrabbling for superlatives at the end of March. The first 3 months of the year were variously the best quarter for Treasury bonds since 2016, the best 3 months for Chinese shares since 2014, the top quarter for US small caps since 2011, and the strongest start to the year for the S&P 500 since 1998. However you look at the March quarter, it was a good time to be an investor. Unusually, it didn't matter whether you favoured bonds or shares. They both went up, as stock markets viewed the Federal Reserve's newfound dovishness as a positive for shares, while bond investors saw growth concerns as a reason to head for the safety of fixed income. It's almost certain that one of these arguments is wrong, but for the time being, investors are happy to go with the flow and accept the rising value of both sides of their portfolio. Starting with shares. The rally in the main US benchmark follows the S&P's biggest December drop since 1931, which had taken it to within a whisker of a bear market, usually seen as a 20% peak to trough fall. By the end of March, US shares had risen by 13%, repairing some of the damage and delivering the best 3-month advance since September 2009, and the best start to the year since the dot-com boom. As risk appetite increased, growth stocks such as those in the technology sector led the charge. The Nasdaq index rose by 16%, while the Russell 2000 index of smaller companies was more than 14% higher, its best quarter for 7 years. Shares rallied despite a two-way pull in the market between the positive of a U-turn by the Federal Reserve and mounting fears that the days of strongly growing corporate earnings are now over. The Fed's change of heart since last autumn has been dramatic, with the US central bank shifting from a steady-as-she-goes tightening path via more cautious data dependence to an apparent shelving of any plans to hike interest rates at all. Such is the power of monetary policy in determining the path of the stock market that investors have, for the time being, parked concerns that company profits may be heading for their first reversal in 10 years. According to data from Refinitiv, formerly Thomson Reuters, S&P 500 companies are expected to see a 1.7% decline in earnings for the first quarter, as companies struggle to pass on rising wage, transport and raw material costs. A record 58% of respondents to a widely watched business survey by the National Association for Business Economics said costs were rising, while only 19% said they had raised prices to customers. While US blue chips are expected to see just 1 quarter of falling profits, so technically not qualifying as an earnings recession, mid and small cap companies are expected to see consecutive falls. The slide in profits follows a surge in earnings last year on the back of President Trump's tax reforms. Although US shares performed well in the first quarter, they were far from the biggest gainers in the first 3 months. That accolade goes to Chinese shares, which had a dreadful 2018 and have bounced back in style. The resurgence in Chinese equities was capped on the last day of the quarter by a 4% rise for the CSI 300 index of Shanghai and Shenzhen listed stocks. First quarter returns as a result were 29%, well ahead of the following pack of Colombia up 19%, Greece 18% and the UK 16%. Chinese shares have come back into favour for a couple of reasons. First, Chinese A shares received a boost after MSCI moved to accelerate the nation's increased weighting in its flagship emerging markets index. Second, hopes are rising that a breakthrough may be imminent for the trade talks between China and the US. Positive noises emerged from the talks last week in Beijing, and follow-up discussions in Washington this week are scheduled, with hopes high that a deal can be prepared for Presidents Xi and Trump to sign later this month. In light of all the good news driving stock markets in the first quarter, the performance of bonds has been slightly puzzling. Here the logic is that the Federal Reserve glass is half empty, that the Fed's unwillingness to raise rates further is a sign that the US central bank knows something about the economy that the rest of us don't yet. The fall in yields on longer dated bonds, like the 10-year Treasury, has been spectacular, from more than 3.2% 6 months ago to under 2.4% recently. That kind of move is only justified by an expectation that the economy is slowing so fast that the Fed will shortly have to not raise interest rates but actually cut them. That's certainly the implication of moves in financial futures, which suggest a non-trivial chance of the next move in US rates being downwards, perhaps later this year. Falling long-term bond yields and persistently high short-term ones creates a situation which has in the past been a reliable warning of economic trouble ahead. Typically, long-term yields are higher than shorter ones to compensate investors for the greater risks of lending money for an extended period. That's both the risk that money will not be repaid and the more likely risk that inflation will erode its real value by the time it is repaid. If long yields fall because investors are concerned about long-term growth and are unconcerned about inflation, then the so-called yield curve, which measures the relationship between yields at different maturities, flattens or inverts. This is the situation we find ourselves in now, and in the past this inversion has always preceded a recession, although the time lag before the downturn arrives is very variable. Now, one of the victims of last year's fourth quarter market slide was the new issues market, which saw a 99% fall in the proceeds from stock market listings in the first quarter of 2019 compared with the same period last year. Including follow-on deals for companies that are already listed on stock markets in Europe, the number of transactions also plunged, down by half to 81, according to Refinitiv. The dearth of deals was worldwide, with sharp falls in the UK, China and US, as well as Europe. Nervous markets make shelving an IPO an easy decision to make, although many of the deals do tend to be reheated once markets pick up again. This has certainly been the case this year, with March seeing a relatively buoyant total of 404 equity deals launched, suggesting a much better second quarter ahead. One other asset which has enjoyed a strong first quarter is oil. The rise in the oil price since Christmas has been even more dramatic than the rise in share prices. The Brent contract has risen since December the 28th from $51 a barrel to $69, a gain of nearly 40%. Now, you know the oil price is getting high when President Trump starts tweeting about it, and sure enough, last week he took to Twitter to complain about the price of crude. This has everything to do with the president's finely tuned sense of what is good or bad for him electorally. With an election due within 18 months, Mr. Trump is calculating that cheaper gas on the forecourts is better news for him than higher profits from America's resurgent oil industry. That's why he's putting thinly disguised pressure on Middle East ally Saudi Arabia to keep pumping to put a lid on the oil price. Saudi is a reluctant accomplice here, struggling to balance its books and to fund an expensive transformation of its fossil fuel dependent economy. The kingdom would much prefer oil to rise to $80 or higher. It's unlikely that Mr. Trump will allow this. And finally, Brexit. It seems superfluous to say that this is yet another big week in the endless Brexit saga, but it really is. Having seen 4 soft Brexit options voted down by Parliament on Monday evening, Parliament remains in the position of having rejected everything and supported nothing. Today, Cabinet meets to try and find a way out of the impasse. Tomorrow, MPs take control of the agenda once more to try and force through agreement on something. Anything would be a step in the right direction. Meanwhile, the clock is ticking and Europe's patience wearing ever thinner. Next Wednesday, a summit in Brussels will decide whether to grant a further extension to Britain to sort itself out. It will only do so if Mrs May goes back to them with a concrete plan they can accept. Before then, she'll probably try one more time to get her own withdrawal deal, defeated 3 times already, through the House. Once again, the biggest surprise of all is that investors are holding their nerve. The FTSE 100 stands at a 6-month high, back where it stood before the fourth quarter wobble kicked off, and the pound remains above $1.30 for now.